Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is July 31st, 2025. And today on our call, we have back the CEO, Jeff Swainson from Solventless Concentrates. Simply Solventless trades on the TSX Venture Exchange under the symbol HASH or HASH. And it also trades on the OTC under SSLCF. The company is currently trading at 34.5 cents with about 108 million shares outstanding, or about a $38 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trevor. Jeff, great to have you back. I think since we last spoke, there's been a number of different events that have sort of asked us or driven us to ask you back. So glad to have you on. Why don't we just dive right into it? I know we've done a number of interviews with you, so most of the people know about the business, but why don't we give us the elevator pitch and then we can get into some updates.
Yeah, so first of all, thanks for having me, Paul and Trevor, and everyone for joining. And yeah, so at a 30,000-foot level, we're at heart a solventless concentrates manufacturer. We're a licensed producer in Canada. We now have 4 facilities. Over the last 15 months, we've completed 4 acquisitions, achieved quite solid organic revenue growth, and we have some ambitious plans, and obviously we had a bit of a challenging spring, but we're working through those challenges, and we think we're on some pretty solid footing and have a good value proposition moving forward here.
Perfect. Okay, so since we last spoke, we've had a CFO change. You've announced the Sluggers partnership, and then the Humble Grow decision to increase capacity at Humble Grow. Maybe we'll start with that last one there, Humble Grow. Why the expansion, and how are you going to finance it?
Yeah, so in the context of our cost of capital and essentially, just the situation that we're in, where we've essentially put a pause on acquisitions, Humble is very low-hanging fruit on revenue growth. So the Humble retrofit, Humble's currently producing just under 9,000 kilos of cannabis per year. We sell every gram that we produce. It's very high-quality cannabis. And for about $2.5 million, we can retrofit the facility to increase production to over 15,000 kilograms conservatively. And so, of course, that increases revenue from approximately $9 million per year up to, 18 to 20 million potentially per year. And so it's a great return on investment. And of course, the demand for dried flower has increased over the last 6 to 12 months in the space. The glut of very low quality inventory that was produced during the funded capacity era back in 17, 18, 19, 20 has now been depleted, and so we have supply demand neutrality. And international obviously is taking a lot of cannabis from Canada. We're participating in the international market to a relatively small degree. We have really good domestic demand. And so the Humble retrofit made a lot of sense for us because we can finance it with just a small amount of equipment financing, and then a large portion of it we can finance with cash flow from operations.
Okay, I'm going to come back to that whole cash flow word or a couple of words you used there. How fast do you think this expansion takes effect?
So we're kicking it off now, and essentially we're retrofitting one grow. The facility is basically over 200 grow pods. It's individual grow environments. So we can do essentially one block of grow pods at a time. And so we'll start essentially immediately. We've already commenced, and it'll take probably until early 2026 to start achieving the new revenue levels and the retrofit production.
Gotcha. So it's sort of incremental growth. It's not like binary, it's all or nothing.
Exactly. So we'll do the first one. It'll harvest, late 2025, early 2026. But then by the end of the year, all of the entire facility will be retrofit production.
Gotcha. Perfect. And maybe talk to some metrics around Humble Grow. What are you seeing as far as the sale price right now, and what's your cost of production?
Yeah, and so that's one of the attractive things about the asset when we acquired it was its cash cost of cultivation. Right now, it's in the 80 to 90 cent range, and that's being conservative, which is one of the lower cost of production in Canada for an indoor grow. Hybrid greenhouses can be a little bit less, but and so right out of the gate with Humble, we did an aggressive rationalization. We brought the staff down, from just over 100 down to about 52 ultimately, and it has great steady state production, and but as a result of those efforts, we've seen cash flow from operations, cash flow of the entity right out of the gate, and so it's one of our best business units, and of course, the incremental production and revenue from the retrofit is going to increase EBITDA substantially.
Mhm. Now you said 80 cents, 90 cents per gram to produce. What are you typically getting right now for that product?
So for large and small flower, typically around $1.50 per gram, and then of course, the trim and things like that is lower price. But the pricing has come up over the last 6 months. It's gone up from an average of about $1.25, probably up to about $1.50.
Mhm.
And so we have seen the impact of the rising price environment and the supply demand balancing.
Yeah, no, we're definitely hearing that from a number of different sources as well. Um, you announced a partnership for a Sluggers brand product. Why don't we talk a bit more about that? Tell us why and what the benefits of this are and how it's going so far.
Yeah, so Sluggers is a started out as an infused pre-roll brand in the United States and California. Um, and as I'm sure a lot of people on the call are aware, the Jeters of the world, Claiborne, they're US brands that have come up into Canada through LPs and done very well. Jeters is along with General Admission, probably, the number one infused pre-roll brand in Canada. And Sluggers is in that group in the States. They're not quite as big as Jeters, but they're a very strong brand. They're getting a lot of traction. And so we were able to secure the exclusive co-manufacturing services for Sluggers and license and we were able to license their brand. And so essentially what we're doing now is rolling out the Sluggers brand into Ontario and then Alberta. And we're very excited about the prospects of that brand, just because we do have the case study of the past US brands coming up to Canada and being quite successful out of the gate. And so with the launch, we've seen huge demand from key retail that want to pick it up, that want to have quite elaborate launch parties and launches throughout their entire retail network, and so we're very encouraged by the prospects of the Sluggers brand.
Mhm. Now, in all our discussions, never, I think, did we talk about any of this type of partnership. Um, it's obviously a nice new idea, but is there more opportunities to do this type of sort of co-partner or co-branding, I guess?
Yeah, and we do some private label work, which is somewhat analogous to white label, which is what we're doing with Sluggers. But there is a lot of opportunity in Canada with key retail to assist them with manufacturing their house brands. And we do that already, and we've had quite a bit of success in the last 6 months with private label, and so it's definitely part of our business that we really like, and to the extent possible, we want to participate in that part of the business.
Mhm. Mhm. Gotcha. Okay, another big event here was a new CFO. You've got a new CFO now in place. To some degree, I know say you were CFO challenged for the last little while. Why the change? What happened? If whatever you can sort of tell us about what happened with the past CFO, And more importantly, what's your expectations going forward with the new CFO?
Yeah, and so, just as things evolved, we just thought that a change was appropriate at that time, and so we made the decision to explore bringing a new CFO on. And so, through that process, we had quite an extensive process. We were able to identify an incredible candidate named Ananth Krishnan. He's currently the VP Strategy and Corporate Development at Aurora. And so he has a long background in, starting in investment banking with Scotia and BMO, and then getting into fund management, private equity, and then ultimately into cannabis. And he was, he played a very large role in Aurora's turnaround from, essentially on the brink of insolvency to one of the most profitable and cash flowing LPs in Canada and the world. And so, he did a great job there, and basically he wanted a challenge to help build a company and take Simply Solventless to the next level, and to bring some of that big league experience that he has to our team, and so we're very excited about Ananth joining.
It's fantastic. And so when does he officially start?
He'll start on August 18th, so he had
Okay.
a 1 month notice period, and he gave it on the 18th. So
No, perfect. You've been through quite a bit of turmoil here over the last couple months here. What is the focus on right now? What do you think the market isn't appreciating or investors might be missing here in terms of what you're doing to, I'll say, bring confidence back to the market? What's been going on that side?
and so one thing that I believe was overlooked to a large degree was the ANC prom note settlement. Pursuant to the ANC acquisition, there was about 7.15 million of prom notes outstanding. Essentially, through that transaction, which we kicked off in June 1st, we eliminated about 600,000 of the prom notes. We settled 3.4 million of the prom notes with equity at 50 cents a share. And this was during the most turbulent time, and they took shares for 50 cents, and then we deferred the remainder of the prom notes for up to 2 years, and so it was a significant positive impact on our balance sheet and our cash flows. So that's one thing, but moving on into more the business and operations side, our focus is really entering new provincial markets. We're predominantly Alberta, Ontario, and then Saskatchewan, Manitoba, but we're really making a concerted effort to advance into BC and also the Maritimes. Those are completely untapped markets for us that'll bring a lot of upside. And of course, we're focused on cash flow. To us right now, it's all about just cash flow from operations. Obviously, we haven't financed since February 2025. And at the end of Q1, we had about $1 million in the bank. And so, we've been able to cash flow, and a lot of the rationalization work we did in March. In March, we had a round of layoffs, unfortunately, but because of our strategy of consolidation, that's really necessary to drive the synergies. And so we had a round of rationalization in March, and that is now coming into effect and through Q2 and into Q3, where it was about $200,000 of cash costs per month that we eliminated. And so we're really focused on cash flow from operations and balance sheet strength, and regaining that footing that we had before, and the momentum, and working on getting our cost of capital back.
Mm-hmm. And do you think, are you satisfied where you are as far as rationalization of the current business, or do you think there's still more work to do there?
Yeah, there's a little bit more work. I would say the majority of the rationalization is completed, and we're into the short strokes, I'll say. But there's still, there's probably still 50 to 100,000 a month of rationalization opportunities that we are exploring, which would all, it would go straight to cash flow. And so, I guess the work is never complete, so to speak.
Mm-hmm. Mm-hmm.
We did a good job out of the gate, and getting the low hanging fruit, so to speak, and and ensuring that we captured most of the savings. But over time, we're just fine tuning it and getting as much as we can out of it.
Yeah. No, perfect. Okay, so now let's kind of look a little bit more forward. You mentioned you kind of paused some of the M&A side of the business. You've got some good organic growth opportunities within the business. What, if anything else, is there anything else that investors should pay attention to, sort of looking forward? What can we expect to be sort of the growth areas or things to concentrate on?
Yeah, so Sluggers is number one, I would say at this point. It's if you look at Jeters, and I'm not saying it's going to be Jeters, but it was doing $1 million a month revenue very, very quickly. And so if we're at 50 million, say, like Q1, there's a potential to add a significant amount of revenue just from Sluggers alone. We have a lot of momentum with our Status brand, which is a brand that ANC developed in-house. It's gaining a lot of traction in Alberta and Ontario, almost like a cult following, dare I say. And then we're doing a rebrand on our Royalty brand, which is great products. Just needs a bit of a refresh in our view. So we're doing that to drive organic branded revenue growth, and then of course the new markets. I mean, we need to access BC and additional markets, and we're doing that. And so all things considered, there's a prospect for some pretty significant organic revenue growth here, and to exit the year at levels substantially higher than where we are today.
Gotcha. Let's talk about the industry in general. Are you seeing anything out there? You're obviously at the front lines here. Is there anything going on in the industry that we might not be aware of? Obviously, we mentioned a little bit about pricing for flower seems to be strengthening. Anything else you can point us to?
Nothing new, I would say. We're of course facing the typical challenges with excise and things like that. There was, there's talk of some regulatory changes in Germany that could potentially impact the export market into Germany. That hasn't come to fruition, and we don't know whether it will or not. But at this point, you're seeing some groups that are achieving cash flow from operations. You're seeing profitability come into the space and some strength, and you still have an environment where entities are significantly undervalued. A lot of our peer group, they're trading, some of them are 10 times EBITDA now, but a lot of them are still in that 5 times EBITDA range. We're at just over three times annualized EBITDA. So there's a lot of the entities that are separating themselves are starting to achieve a little bit better valuations, and I think that as an industry, it's starting to get a little bit more attention than we had seen over the last 2-3 years, really. And I think that's going to be good because we'll probably see some deal flow in the industry, maybe some more transactions, and maybe some capital will start to flow back into the industry, which would just perpetuate entities driving down costs and increasing efficiencies and achieving better cash flows and profitability.
Yeah, we are starting to see that there's some either refinancing or at least capital that's starting to look at playing in the space again. Remind everybody it's listening, if you've got a question you want to ask, please use the chat function. I'll ask. There are some questions starting to line up, so in a second there we'll address them. The question I always ask is kind of what keeps you up at night right now, Jeff. I was going to ask earlier what's working, what's not working. I think we've got a pretty good idea. But what is kind of your number one, call it, challenge that you think the business is facing?
Yeah, so obviously with our consolidation strategy, our cost of capital just isn't where it needs to be. We need to continue to drive momentum, on our stock price and achieve a better cost of capital. And we're certainly believers. I've been in the market 3 times in the last month or month and a half, and there's a lot of opportunity out there with the appropriate cost of capital. That's not our focus now, as we've kind of conveyed here. But I'd like to get us back to where I think we belong, and I realize it's a process, and it takes an army of great investors and a huge team of great people, and it takes a lot of effort. But I think we're on the right track to get there, and when we do, then I think that we'll be positioned with the track record of executing pretty good transactions and to really scale the business.
Perfect. Okay, Jeff, let's jump on some of the questions that come in here. We've had a couple that have come in from our Discord. I'll talk through this one. It says, can we get a deeper breakdown of what makes up the current CRA tax and excise tax liability at around 6.5 million as of Q3, and whether there were cases, whether there were cases of deferred excise payments?
Yeah, so like a lot of LPs through the years, we've accrued an arrears balance with the CRA, and of course the CRA about a year and a half ago, realized that they really had a lot of leverage, and so we have that balance. Some of it has been acquired, some of it hasn't been acquired, and so it's around $6 million, and we're actually in negotiations with the CRA now to defer that over 3 years. And so, that would be a material positive impact to our balance sheet. Basically, 4 million or more of that excise balance would go into long-term liabilities instead of current. And so, in the context of our revenue, our CRA balance isn't what a lot of entities, unfortunately, are experiencing. But it's something that we're on top of, and just like the vast majority of entities in the business, we're managing our arrears balance and getting it paid down and staying current on our monthly excise.
And maybe you sort of answered this just in what you said here, but it says, second part of the question is it seems high relative to package inventory and sales, and seems to have rapidly increased in 2024, acquisitions considered. Was there something different that happened over the last year or so, as far as excise?
No, I would just say the acquisitions, solely would be the primary point there. Of course, our revenue grew from 7 million in 2023, and now we're at the 50 million annualized level. And of course, with that level, like right now, we're paying $1 million a month current excise, and so $6 million is basically of an arrears balance is 6 months of our current monthly excise rate, and in the context of the industry, it's actually moderate, I would say.
Gotcha. Okay, Daniel asks, could you reflect on the Can-B acquisition? What went wrong? What went well? And are there any lessons learned from that one for future acquisitions?
Yeah, so it's essentially, I guess we prefer private company deals over public. It's as we look back, it's a long time ago now to us. It's I guess it's only a few months, but to us it seems like forever ago. And it's just maybe focus on private. Public company deals are a lot harder because you can't get the lockups the same way as you can with private deals, and you're dealing with a lot more people, and but ultimately at the time it was pretty disappointing how that unfolded, and how we were informed and everything like that. And it is what it is. We've demanded the break fee, and it won't be our focus, but certainly we're not going to forget about that, and we'll probably pursue that in due time.
You know what? I mean, you were sort of looking at that business because it had specific sort of products and services. When you look back, or maybe looking forward, what area do you think you still want to look at in terms of potential, acquisitions? Is there a part of the market that you think you still need to beef up?
Yeah, so I mean, we like their infused pre-roll business. They're quite large in infused pre-rolls across Canada, and so with our manufacturing capability in pre-rolls, it made a lot of sense. In terms of the acquisitions, I don't think I should even get into the kind of direction that we would be looking at this point. there's in terms of infrastructure, there are some gaps in our current infrastructure, mainly hydrocarbon extraction, which is also what Canadabus specializes in. So we're also in the process of still bringing it in house. We put that on pause because of the Canadabus acquisition, and now of course we've kicked that off again. So, but in terms of infrastructure and asset bases, hydrocarbon and ethanol extraction would be two areas that we're deficient in, and aside from that, it's going to start to get redundant at some point. Of course, even with all of our acquisitions, there's redundancy, but we can't just keep bolting on the same businesses all the time and expect exceptional returns. And so there's a few different directions that we're exploring pretty heavily. But I'm gonna keep that tight for now.
Let's go back to the Sluggers opportunity. I'm curious to see how you roll this thing out. What sort of marketing spend, or what do you have to do on the marketing side to hopefully be successful on a product like that?
And so that's the beauty of the Sluggers deal, is that we're responsible for the manufacturing and the inputs, and they're responsible for the sales and marketing. And if you look at them in the States, they're highly proficient in sales and marketing. And so we both get to focus on our core competencies in that regard, and we have full faith that their marketing and sales team are going to drive sales in Canada, and it allows us to just focus on what we're good at in manufacturing, and assist them as best as we can, and enjoy the success that I believe that they'll drive.
Is it a case where if they're not successful in pushing demand, you guys really don't have any let's say excessive costs, or how do we look at that? Like they're spending the marketing money, so obviously that's a risk for them if they're not successful. But what risk do you guys bear if they can't get demand up there?
Yeah, so essentially the only real risk we have is working capital risk on inventory and manufacturing, and making sure that we're manufacturing the correct amount of product for the launch, et cetera. But we can manage that pretty closely. I think most LPs are fairly adept at managing their inventory levels overall, and preparing for launches, and we've all been through it enough times where we can predict fairly accurately the launch volumes. And with a deal like this, we are encouraged. So of course we would manufacture more than we would for some launches. But the risk, I would say, is very minimal given the potential upside of the deal, and the positive things that being associated with Sluggers will bring to Simply Solventless.
Gotcha. Okay. Trevor asked a question here in terms of excise tax. Is the excise duty on exports the same as the whole market?
So on exports, there is no excise at all. Same with the B2B domestic market. So as an example, Humble Grow Co. sells all of its product either B2B domestically or internationally, so it pays no excise, other than some very minor recurring CPG sales that we have, which is just not even 5% of the business. So and that, that's one of the attractive things is non-excisable revenue, B2B. Of course, ANC's tolling operation and co-manufacturing operation also doesn't incur excise taxes, and so as a percentage of our revenue corporately, it's more in that 20 to 25%, whereas a pure play high potency product extractor business will pay upwards of 40-45% excise.
Yeah, it's pretty amazing. Okay, Dom asks, we've noticed your buys. Now, what's the chance we see other insiders buying as well?
I think, I can't speak for them, of course, but we all believe in the business, and I'd be surprised if we didn't see some in the near future here.
And Paulo asks, are you pursuing the Can-Be breakup fee, or is it not worth it right now?
We're not actively pursuing it, just because there's, our resources are better focused elsewhere at this point. And we're like I said before, we're focused on the future, and we're focused on creating value, and we're focused on incremental value creation, which we're doing, and in achieving cash flows. And at the appropriate time, we may look at it, but it's not going to be a priority for us at this point.
Mhm. What gets you the most excited right now about the business? I mean, you mentioned Sluggers, but is that what gets you the most excited right now?
No, what gets me the most excited is just our team and all the hard work that we've put in over the last 6 months. Our resilience over the last 6 months, where it was very, very, trying times, and very difficult to navigate. I'm proud of how we've come to this stage through these tumultuous times, and I'm excited about where we are today, and how we're positioned for future growth. I believe that there's really strong revenue growth capability here in the fairly short term. And we do have strong fundamentals. Obviously we had the adjustments that were into one quarter, and we've explained that before. We had a pretty extensive call on that, but we have a good business here. There's further rationalization opportunities. We have a really good, solid set of infrastructure and assets. And like I said, to start, we have a fantastic team. And so, I think the resilience matters, especially in the cannabis industry. And we're just excited to move forward and to build the business and provide value to our shareholders.
Mm-hmm. Do you see a need for financing right now? Is that something you look at doing?
No.
Yeah.
No, we're just running with cash flow and operations, and as I said, we haven't done a financing since February, and so we're not pursuing financing at this time, and if anything, we're looking to whittle down our debt balances the best we can, and have the strongest balance sheet possible going through 2025 and to end the year.
Mm-hmm. And okay, so Jill's asked a question. I'll read it verbatim, but what is your definition of profitability for this business?
Yeah, so I mean, obviously there's numerous ways to define profitability. Net income profitability obviously is important. Q1 we were net income profitable, EBITDA positive, of course. But then what we're really focusing on is cash flow. Cash flow from operations, and then ultimately free cash flow is what our focus is. And we're pretty encouraged with what we're seeing there right now.
Mm-hmm. Jeff, I always ask this question. If you were in our shoes looking at the business right now, what do you think is the most important thing to pay attention to going forward?
Yeah, I would say probably, continued revenue growth. That's important. We have our infrastructure in place. We have, a very reasonable fixed cost structure. Any incremental revenue and contribution margin basically goes straight to the bottom line. So, revenue growth is very important. And then, I think I don't want to sound like a broken record, but, cash flow from operations is probably, the number one most important thing right now. If we're going to look at cleaning up our balance sheet, we need good cash flow from operations, and then seeing our cost of capital coming back, and which will at that point open up doors to other opportunities.
Yeah. Okay. So last question I'll take from the audience here. Joseph asks around CapEx. Will CapEx increase in the second half of this year? It seems insignificant in prior quarters. For example, CapEx seems to be run rate or on average of $100,000 quarterly. Do you have line of sight into 2026 CapEx?
So we haven't looked at 2026 CapEx. At this point, I would say it would be almost zero. But we will have CapEx in H2 2025, which is related to the Humboldt retrofit.
Yeah.
So that'll be approximately $2.5 million. And then we have some CapEx related to the hydrocarbon system implementation, which would be about $500,000. So I'd expect to see about $3 million total. And it's all elective. It's not, none of it is required. It's elective to earn, to earn margin, and to increase revenue, and to improve our business.
Jeff, like I said, it's been a challenging last couple of months here for sure. Um, what do you want to make sure everybody understands about the business and everybody, really, what's your key message and takeaway for everybody today?
Yeah, I think that just we're here to work hard. We're here, with skin in the game. We care about the business immeasurably. We always have. We're some of the largest shareholders. We want to participate and we want to win with our shareholders. Um, and you can't say that about every LP out there or every cannabis company out there. And you know, if there's one thing I could say, it's just that, we appreciate the you know the trust of our investors at this point, given everything that we've gone through, and it's going to take great investors like we have, and it's going to take great team, and it's going to take a lot to get through this, but we're going to work endlessly to do that, and we're going to be along for the ride, and we're heavily invested, and we're pretty excited about where we're going.
Mhm. Now, I lied. There's one more question I think it is important to answer here. Greg says, are you still confident that you'll be achieving positive free cash flow in Q3 of this year and going forward?
Yeah, I'm confident. Like I say, we didn't finance since February, and our cash balance is going up. So, I'm confident that we'll continue on that trajectory. In terms of free cash flow, obviously the capex associated with the Humble retrofit technically comes out of free cash flow, so that'll impact it. But certainly, cash flow from operations, we should be positive.
Mhm. Mhm. Listen, I've mentioned that it's been a trying time the last couple months here, certainly. I want to say that I'm impressed with what you guys have managed to do in the last several months. Certainly, from a optic and capital market side, I think you're doing absolutely what needs to be done to bring confidence back to the stock, the insider buying, the strategic moves that you've made, and obviously bringing on the CFO, I think is a big step forward. So my hat's off to you. I know this is not easy. I've sat in your seat on the other side of the public line here, and I know it's not easy. So hats off to what you've had to endure and kind of how you're coming out of it. So congratulations on that. We've been speaking with Jeff Swainson, CEO of Simply Solventless Concentrates. Of course, symbol is HASH on the venture exchange. SSLCF on the OTC. As always, Jeff, it was great to catch up and certainly look forward to another chance to do it in the future.
No, thank you, Paul and Trevor, and everyone on the call. It's, we're very fortunate and blessed, that you're here and giving us the opportunity to continue to tell our story and to execute. And that's what we really want to focus on is just solid execution. And I look forward to the next time that we can have a chat.
Perfect. Awesome. Well, listen, we'll look forward to that. But for now, we'll say goodbye and thanks one more time.
Thank you, Paul.
Bye for now.
Bye.